Okie dokie. Well, this one also in typical Alex fashion should be a very nice, engaging lecture on modeling and designing your models. Chris, for you guys, actually, I didn't. Well, actually, no, I did. I done the deterministic models, as I'll explain in a second. But the stochastic models on the token price and stuff, we obviously didn't run. Brevity from Ale. What does brevity mean again? I feel like I should know that.
Just being brief or quick, brief.
Oh yeah, oh yeah. Well, quick in the intro. The actual lecture will be quite. I will definitely be talking a lot. But Chris, this might actually be quite useful for you guys as well, because we done the deterministic but not the stochastic models. But anyways, let's get right into it. So modeling.
Good morning, Alex.
Good morning. As per usual, some information about Simplicity Group. Obviously, you already know that. So, what is modeling? It's simulating the reality. It's not predicting the reality, right? As I have a very nice VR person over here. A lot of people think that, oh, we're going to run the models and then that's exactly what will happen to the token price. They are always wrong. That's not how it works. You can model something out, but you know, they say the best way to model how the smallest computer that you would need to simulate how the air particles in a room would interact with each other is the room itself, because it's a very complex system, and I'll go into that in a bit more detail in a second. But basically, the point being, there are always things and factors that you cannot account for, even if you have, you know, a list of 100 pages worth of assumptions and inputs and data. Doesn't matter, you know, you'll never be able to predict the future. And especially, you know, give it 2-3 months. Let's say you're simulating the token price. After 2-3 months, your entire model is basically wrong already, right? Because the error in the assumptions just compounds so fast and so exponentially that it's basically pointless. But it's not pointless if you understand you're just simulating the reality, not trying to predict it. And what that means is you can use the outputs of the model as a map. You can see, okay, well, if we have this, then we should have this. Now, ceteris paribus, I mean, meaning all else things being equal. So assuming there's no exogenous factors, you know, Bitcoin price isn't dying, the world isn't in a war, things should look like this if these are the factors. If you come here with that logic, then modeling is very useful. So in order to model, you need to have 3 things. You need to have the inputs, which are made out of data or assumptions. And you need to have the mechanics, which is just how those inputs interact, so like the formulas, the logic, etc. And then finally, you have the outputs, which is what you want to see. So your revenue, volume, TVL, users, stakers, whatever else, anything that you can quantify and anything tangible in that respect. So for example, you know, here are some inputs. You have the users, you have their monthly volume, and then you have some sort of transaction fee. Well, if we multiply that together, we get the revenue for the protocol. If we multiply the user by their monthly volume, we get the volume for the protocol, right? So that is basically what modeling is. The system that you're trying to model, or rather the system that the outputs that you're trying to model live in, determines the type of modeling that you need to use. There are 3 main types of modeling, which is deterministic, which is models for static calculations, fixed sequence systems, where every run has the exact same output, no matter how many times you run it. This is used for physics. It's used for things like projecting your revenue. It's used for things like calculating volume and fees. Because you have fixed inputs and you have, well, therefore, fixed outputs. Stochastic models are for more complicated systems, when you have randomness and when you have recursion. So this is for things like capital markets, or for realistically anything that includes a token, because the deterministic systems, primarily they don't have recursion. For example, if I say the token price is $1 right now, and I'm going to have 1 million people buying $10 worth of the token, right now they're going to buy 10 million tokens. The next month, the token price may have changed because of all of that buy pressure from the month before. So now they're not going to buy 10 million tokens because the token price is much higher. Now they may only buy 2 million tokens. Then the next month, the same thing happens. So one input remains the same. Every month they're buying $10 million worth of tokens, but because the price changes and is recursive in line with the buy pressure, the amount of tokens that they buy also changes. which then impacts the amount of tokens that they have staked, which then impacts the amount of tokens that they sell, which then impacts the price once again. And it all connects to one another. And it's for that you need stochastic modeling. You cannot model things like token price in a deterministic model. Well, you can. It'll just be completely wrong and pointless. Lastly, you have agent-based models, which are for understanding complex systems, complex macro systems from the perspective of specifically individual agents. So this is to understand traffic, to understand society, geopolitics, right? You typically do not need such complex modeling for something like a token economy. It's just, you're just going to waste, hundreds of thousands of dollars, and you're going to get basically nonsense that is completely, within one Bitcoin price movement, everything becomes irrelevant. So it's just a waste of money, in my opinion. But there are some cases when agent-based models are good. I'm not gonna lie there, but it's far and few between. Now, when to use what model? Again, to put it simply, deterministic models when there are no recursive inputs. So one input doesn't affect the other one, which impacts the first one in return. It's very straightforward, x equals y. Simple systems. Stochastic models are when you have recursion, or when you want to model that randomness. Maybe you don't want to say you're going to have 1 million users each buying $10 worth of tokens, but maybe it's 1 million users plus minus 100K buying $10 plus minus $5. So you have that randomness, and that's what you want to model out. And it's used for complicated systems. And agent-based models is when the emerging macro environment cannot be explained with aggregate equations, which is, in other words, one of the definitions of a complex systems. Now, as I said in the beginning, I'll explain what complicated and complex are. They're very different things when you're talking about, well, modeling or science or whatever. A complex system, the way that you define a complex system, is one of the definitions, rather. There are a few, like self-emerging and a few others, but one of them is the fact that you cannot use a kind of like a macro equation for the entire environment to predict what will happen in the future. Or in another way of putting it, if you take apart this entire system into its individual parts, you cannot put it back together. It will not work. With stochastic models, or complicated systems rather, you can. So for example, a jet engine is a complicated system. There are so many different moving parts, and yes, they kind of all relate to each other. You have to screw in this bolt, then this nut. But you can take it apart, and then you can put it back together again. It will always work. Complex system, you can't. You can't pick apart the atoms in the cloud and then put it back together and expect to have the same weather pattern going forward. There are an incomprehensible amount of factors, which is why, again, things like traffic, for stuff like that, you need to have an agent-based model, because you cannot have the inputs that you can have in a stochastic system and expect this very complex environment to work properly. Now, technically, that does mean that you should model token economies with agent-based models, because things like society, geopolitics, etc. I have capital markets here, but that's mainly for things like stocks to some extent. But realistically, you can use an agent-based model to model out a token economy, but it's just a waste of time, because you're trying to model something that doesn't require such complexity, because it's going to be wrong anyway. For traffic, it makes sense. For something like a token price, it doesn't, because there are far too many exogenous factors that you just cannot account for. Unlike something like traffic, the roads will always be the same, the cars will always be the same, ceteris paribus. In a token model, it's just, a KOL can tweet one bad thing about you, your token price collapses. You just wasted $200,000. Right, so it's too complex for what we're trying to model, which is why I'm saying it's not really the best thing, and generally speaking, a waste of money. Here is a graphic that I have made that I'm honestly very proud of, which basically explains what I just said very nicely. Deterministic models, x equals y. You run the run again, x is still equals y. Super simple, just x equals y. That's all it is. There's nothing else. X times a times b times c equals y. It's always the same. The stochastic model, you have x over here, and maybe the output is y plus 1, y minus 1, 1 minus 2. That's kind of that randomness effect. And also it's the fact that x equals y, which also equals x, which then also equals y. Or rather, not equals, but impacts. So x impacts y, which impacts x, which impacts y. And there's an agent-based model, and there is actually meant to be a little arrow here, but I'm guessing that did not export. But that's what the arrow looks like. So you have your individual kind of agents, and they can be modeled out and analyzed to have some sort of understanding of the bigger picture, but you cannot then take that bigger picture on a macro level and break it down into the individual agents. It will not work. So for example, you can say, yes, our whales and our retail users correlate to, you know, $500,000 worth of buy pressure, but you cannot say our $500,000 worth of buy pressure comes from this amount of whales or this amount of users. Well, rather, you can say that, but then when you run the model, it'll be wrong, right? So you need to model out the specific individual agents, and you can't do it in return. So that's basically what this chart means. So that's when to use what model. And once again, you can use whatever model you want. It's just that some will be more accurate than others. You can use a deterministic model to model out your token price. You can use a stochastic or an agent-based model to do the same. It's just that some of them will be more accurate than others, and also there are things like costs and, you know, purpose, if you will, to factor in. But you can realistically use any model for whatever you want. It's completely up to you. Now, in terms of how to model, well, as I said at the beginning, you have your inputs, you have your mechanics, and then you have your outputs. Now, the inputs and the mechanics are the things that we control. They are what we define when we create this model. They're the rules that we use. And the outputs is just what happens after you press enter. After you press run, well, here's the chart. Right? Now, those inputs are numbers, or again, formulas that go into the model. Right? It's assumptions, and they're made out of assumptions, and they're made out of data. Assumptions is anything that you just don't know. So, for example, behavior of anyone, like, you know, your VCs or your users, the users at launch, the users in 6 months, the future growth rate, the buy pressure, the sell pressure, staking and unstaking ratios. So, as in, like, if I have 1,000 people staking, next month 10% will unstake. Revenue. It's things that you just don't know. You can't know them, right? Either you can't know them because you don't have the users right now, for example, or you can't know them because you're looking at the future, or you can't know them because you're trying to predict someone's behavior in the future. Data, on the other hand, is just hardcore stats, if you will. Your users right now, your users in the past, your current growth rate, your current revenue, your current user behavior. Predetermined policies is another one, which is a little bit different, but that's more so for you know, like whatever you input that isn't dependent on anyone else, right? So, for example, at what point is the over collateralization going to cause a liquidation cascade, or how many tokens you require someone to stake in order to get access to that special tier or to buy that node, whatever it is. Those are they're up to you. You literally input a number. That's what the people are going to use. So that number is, of course, data, right? It's hard locked. It is what it is. Compared to on-chain data, on-chain user wallet data, historical price. So, and we'll go into an example here in a second. But the point is, when you're modeling, you need to assume a lot, of course. But it's our job to make sure that the assumptions are grounded in reality and not just pulled out of thin air. You know, it's very easy to say, oh, you know, right now we have 40,000 users, but when the game goes live, we're going to have 1 million users. Based on what exactly did you just make that assumption? And then, you know, they're going to model it out with that assumption, and they're going to be like, oh, well, the token price is actually should be 40 million at launch. Well, it really shouldn't, because you made an assumption that you just plucked out of thin air that has absolutely no basis in reality, right? So it's our job when we do the modeling, and obviously yours if you do this yourself, to make sure that it's all correct and as real as possible. So let's look at it this way. Everyone remembers this lovely economy from the previous lecture, right? So all of these numbers, all of these arrows, that is what the input would be. So that's why we designed the utilities, then the economy, then the tokenomics, only then we do the modeling, because you can very clearly see what the inputs are, right? So let's do a little quiz. Here are some potential inputs from, again, based on kind of this economy. VCs will sell only 20% of their tokens. They're very bullish on us. Is that a good or a bad input? Again, whether it's data or assumption, it doesn't matter. And yeah, go on, Anthony.
That's not a good input.
Yes, great, perfect. Exactly, it's not a good input. Users will probably stake tokens on governance. So this kind of assumption here. Is that a good input or a bad input?
That is also quite bad.
Yes. Users will spend 10% of what they earn on vouchers.
Well, I would say it's bad. It's assumptive still.
Exactly. Yes, it's an assumption, but the fact that users will spend. So, okay, so what are they spending right now? You don't know, right? So that's I'm being a bit pedantic, but it's more to deliver the point. But yes. We will sell vouchers for 10 tokens per voucher.
I'd say it's a good input. It's clear.
Yes, exactly. You determined that. So you said there's going to be 10 tokens per voucher, not someone else. You're not relying on anyone else. So yes, exactly. We will be able to charge voucher partners $50 per month.
I say it's good, but it's a little assumptive still, perhaps. Need more data.
Yes, exactly. Yeah. This one, actually, I edited on the next slide, but I didn't edit on this slide. But just assume this instead says, based on current market prices of the data, we will be able to sell a user data at $50 per month.
That's good data. Yeah, that's good.
Yes, exactly. Based on research. And lastly, we will use 100% of our profit on buybacks.
That's good data. Bad idea.
Yes, but yes, exactly. So that was absolutely spot on. So again, just to reiterate, you don't know what the VCs will do. And also this is just false. VCs will sell maybe 90% of their tokens instead of 100 if they're very bullish on you, or they just sell OTC and then that person will sell all of them. Users will probably stake tokens in governance. Nobody gets involved in governance. It's a facade. It's all a lie. Unless it's Curve, but it's not really. It's just more of a Ponzi scheme, really. Users will spend 10% of what they earn on vouchers. Again, based on what? We will sell vouchers at 10 per token, 10 tokens per voucher. That's, of course, you decide that, so that's fine. Be able to charge. Will you? Who knows? We think based on the market data, we'll be able to sell it. Yes, that's based on data. That's fine. And, again, 100 profit, that's your decision. That's an input. That's fine. So, as I mentioned before, a bad input isn't necessarily an assumption. It's bad data or assumptions taken out of thin air. Bad data can also mean, for example, I can go on DeFi Llama and I can see that this layer one has $1 billion worth of volume a day. Is that real? Probably not, unless it's Ethereum or Solana or Canton or a couple other ones. But let's say Mantra says they have 1 billion volume per day. No, they don't. No one uses Mantra. Not a single person knows anyone that is building on Mantra. So it's fake. So using that data is just false. It's not going to get you anywhere. And a lot of founders, they do this because they want to, basically it's kind of ego and kind of to some extent lying to themselves, right? But it's like, oh, well, this project has 1 billion, so we can do the same. No, first of all, they don't. And second of all, you can't. And good inputs on the flip side is good data. Maybe you go on June, you look at the on-chain, whatever it is. You have your own data, of course, of your own users, and assumptions which are supported by existing data. So when we do models, for example, and we need to assume how many people will sell the tokens, if they're staking, we run some maths if we can on, kind of like profit margins and stuff like that. If they are, in relation to token price, if they are, if it's retail, just buying the tokens speculatively, well, we know based on our own experience and research that retail typically sells at certain price levels. If they do a 2x, if they do a 5x, maybe when the token price reaches, a round number like $1. So we use that kind of, we build out assumptions and inputs based on that sort of data and research and logic. And that's as good as you're going to get, because you can't tell me when 100,000 people are going to sell your token if they're just holding it on their wallet and waiting for the price to go up. It's impossible. But you can have some logical assumptions to it. And again, it goes back to what I said at the very beginning. My brain just blanked. Whatever, doesn't matter. But anyways, both data and assumptions can be good and bad. Now, mechanics, on the other hand, are simply the formulas that determine the relationships between the inputs, which is what I said at the beginning. And there isn't really much to talk about here, because it's just, you're going to assume that a user sells X% of their rewards, or there's a transaction fee, or there is some amount of vested tokens will go into the liquidity pool, or again, profits are used to buy back tokens. It's just, this is just what you need to, this is basically how you build the model out. So when you're building a deterministic model, it's the formulas that you have in the cells of the Excel table. Or when you're building a stochastic model, it's just how the different arrows connect to the different pools, and what are the formulas that that define how many tokens go from this pool to this pool, or from this wallet to this wallet. So it's just that's just what it is. There's not really much to talk about here. But also, well, I mean, of course, the inputs go into the mechanics. Like, what is this X? What is the transaction fee? What is this amount of vested tokens? So all of those are still inputs. The mechanics is just specifically the formulas, if you will. So the same logic applies to the mechanics, right? Again, that's the input. So the purple here is the mechanic itself. So the buyback, that's the mechanic, right? So when you're doing the model, you're going to say, okay, we have this much dollars and we're going to buy this many tokens, right? So we're going to buy, that's the mechanic. This many tokens, that's the input. So that's the golden kind of line. So again, I'm kind of explaining something that's, I feel like, pretty obvious, but that's just, the way to kind of think about it. And finally, we have the outputs. So this is what the outputs look like. And I'm going to show that I'm going to change the screen share in a second. But for deterministic models, if I can zoom in, okay, I can't zoom in anymore. But you have a nice Excel table. You have some sort of, months. You have some formulas over here. Then it gives you some sort of numbers. And the outputs would be, the output would be, you can take these numbers and then you can turn them into this chart over here. So it's just one line, and it will always be just one line, and it'll always be the same unless you change the numbers here, and you get this sort of amount. Stochastic models, however, again, they have randomness, they have recursion, so the charts look a lot more noisy. They have a lot more kind of runs. If you run the model multiple times, you have many runs. And then agent-based models, well, they are incredibly complicated. Again, it's basically stochastic models on steroids, if you will. But it's a mix of stochastic, it's a mix of just a bunch of other kind of statistical different model types and whatever else. And again, you just don't need this, really and truly. Like, I know some people came to us from people that have done agent-based models, and they came to us and they were like, hey, can you look through this? I don't really know if it's good or not. And we looked through this, and it's just they ran like 80 pages on Gitbook worth of all these models and all this data. And deep inside was a little hidden assumption. We're assuming that only 20% of all the tokens that are vested are sold. So the whole 80 pages is just worthless, because that's obviously not going to happen, right? So it's just, and again, it's you don't really need to have all of this to look at your token price, because again, within 2 months, 3 months, it's all going to be wrong anyway. But if you have that, that sort of, well, if you have this amount of buy pressure, then the token price should be this, or if you have this amount of sell pressure, then the token price will drop by this amount. It's kind of like you want to build a map. You want to build an understanding of, if this, then probably this. And then that will be sufficient enough for you to be able to use that data to adjust the tokenomics, adjust the vesting schedules, adjust those policies, those mechanics, just so that, for example, here, you can see there's a massive drop on month 13. Why? Because the cliffs ended, after 12 months. So maybe instead of, having all the cliffs end on month 12, we can, stagger it. So maybe we can have one cliff end on month 4. We can have one cliff end on month 8, another one on month 10, and then, the final one on month 12. And then your chart wouldn't look like this. It will look something like, like that, a little bit more stable, a little bit less bad. So that's what you want to use the modeling for. It's really to adjust the tokenomics and your policies, well, the mechanics, if you will, with the results in mind. So now I just want to quickly show this. So, for example, this is a deterministic model. This is the thing that I screenshot. Thank you very much, Chris, for letting me show this. But this is a rough model, deterministic model that we done for Relief way back when, and it's honestly just to figure out, based on the potential earnings, how much should each validator node be required to stake. But obviously, because the staked amount isn't price, this model is limited insofar as the root price, or the price of the token, remains as what we've inputted here. If we do stochastic models, then we can take all of these tables, and then we can compare them against specifically the token price at that time. But then it becomes a whole recursive, it'll become very complicated, and that's why, stochastic models are typically better. But, for calculating, okay, well, we're going to have this many node trees, and there's some sort of growth rate, which is decaying. Okay, so probably we're going to have this many node trees at this point. That means that we're going to have this many transactions, or this many transactions per notary, and so on and so forth. So it's good to have a rough understanding of your potential user base, and then how much transactions each of them are going to do, and then work backwards to determine some sort of price per node, for instance. But obviously, it's important to keep in mind that the price per node, well, in here, it's okay because the price per node is in tokens, but also the revenue per node is also in tokens. So the cost of the validator node goes down as the rewards go down inherently, because they're both priced in tokens. So it's not the end of the world, but still, it's useful to have a rough idea for how to design the specific formula to calculate the node cost or the returns or whatever else. But if we want to use this to model out the real returns or the real price, it's not going to be that useful. And on the flip side, here we have a stochastic model. Now, this is the software machinations, and this is what I've done for a very complicated DeFi client. And in essence, all we have here, to explain it very simply, you have your tokenomics, so all of the different tokens and the vesting schedules. You have all of the buy pressure over here, color-coded because they have different buyers. You have the validators, you have the delegators, you have speculators, and you have the buyback. It's all formulaed up because there's a lot of different policies that they have in the economy. It all goes into this lovely automated market maker. And then if I click run, then I'll be able to visualize the price. And if I go on this lecture, then this is basically what it would look like after I take the machinations data as a CSV file and put it into Excel and translate it into a nice little chart. And then, over here, you have all of the different mechanics, all the different formulas, and how it all ties together. And as you can see, because all of the economy goes back into being, into the tokens being sold, and also you have the tokens being purchased, the token price is very critical. There are a lot of these kind of gray arrows here that run from, from the token price pool to all of these different areas, and they all determine one another. So, the results from here when it comes to modeling the price, the revenues, the user behavior will be a lot better than in something like a deterministic model, which is just high level and good to model some stuff out. Like, again, maybe a potential node price formula, but not good for modeling kind of like the future of what will happen in your economy. So yeah, agent-based models I don't have an example of. This is from Google, but this is basically what they look like. Even if you go to an agent-based kind of modeling token economist, they'll probably give you something that looks very much like this. They are quite good when it comes to like if you model out, like for example, this DeFi project, the one that I just showed you, machinations, they actually were doing their own agent-based models to calculate their kind of vault and collateralization and their strategies and stuff, because with the strategy specifically, it's kind of like a stablecoin DeFi project, if you will. There's a lot going on, so it's very complex, and a model like this just wouldn't be really good enough for them to be able to backtest and do whatever they were doing. But again, when it comes to the token, you just don't really need it. You can use it, but it's not really the best, I would say. But based on price, if you raise $10 million, by all means do agent-based modeling. It will be better than stochastic modeling. But if you haven't raised $10 million, then the gap in price between the stochastic modelers and the agent-based modeler is literally like 10x, 20x. So I don't know, I've never found it to be worth that much money. And yeah, once again, it's been a pleasure. My name is Alex. For those who don't know, you can reach me via this Telegram over here. And if anyone has any questions, please feel free to ask. Or if anyone wants me to go back and explain something or showcase the examples again, please feel free to ask. Perfect.
I think that was great. Yeah, I appreciate your time. Just give you a heads up. I'm waiting on Paul. Paul's running some sims, but I told him you can do that with him. So when he wakes up, hopefully I'll have something to send over. But if not, you'll see him later today in our call.
Yeah, no, exactly. Perfect. Sounds good. But yeah, all right.